All right, today is Friday, November 18th, and we are past some of these high volatility events such as the CPI, the PPI, and also the election. So now is the next 1 month, no event month, and the stock, what we'll try to do is we'll try to cross the 4,000 barrier. And if it does, then the next level will be the 200 level, 200 days moving average, which is right now is around 4150. So if it crosses that, then the next level is around 4315. That is where we had this August low, August 15th, when we reached that 4515, try to um, touch the moving average at the time, 10 to 200 moving average, and failed. After the Fed narratives, that happened, and everything happened after that in the market. So, where we are right now, where we are headed in the next week or so. In this framework, it's very unlikely that we're going to go test the 3650, 36 level, right? It's June low. What's the catalyst? There could be an event, for example, something geopolitical. The China has subsided. I don't think China anything is happening soon, because China and the Biden and Xi Jinping just had meeting. Then we are left with Russia. It could happen. There might be some events like this dirty bomb or whatever they're talking about. The Poland incident that was not escalated by Russia. So that means that they don't, it's something that Ukraine is churning, but Russia is just like, it's a passive player in a way in this war rather than active from the stock market's perspective, right? So in that respect, I don't think Russia is a big event. Obviously there could be surprises. But then the third option is that if something happens from the Fed side. Now the Feds are talking so much, right? Every other day there will be some Fed, governor would be opening the mouth. We want to go interest, we have to go hike the interest. It's more like, like they had this attention deficit, or they really want some level of assurance from the public. It seems like that's what they're talking. That's what they're heading here. Like, always trying to come to TV and show their presence. Other than that, I don't see that. When you're playing the same card over and over again, it's no longer surprising. So I don't think that market is going to really react that much, unless the Powell says something again very drastic. So what happens? What will happen? From the market's perspective, what the Fed are saying is that we're going to raise interest rates. So if you look at the Fed future fund for next March, it's pricing it around 4.8% interest rate. Right now, the 2-year is at 2-year US bond is trading around 4.4, 4.45. The 10-year is trading around 3.8. Remember that I mentioned that in a video back in I think October, that right after this Fed meeting, when we have this, there will be some level of, relief from either from the CPI or Fed kind of pauses. And when that happens, what's the next step? Right away, the next step is that 10-year yield and the 2-year yield spread will widen, and exactly that happened. So right now that we have the yield actually close to 60 basis point, right? And that is basically indicating that we're going to have a very big recession, and that recession is is priced in. It's probably most anticipated recession, a lot of folks are saying. In any case, right, like the other aspect of it is that we do see that there is this very strong consumer.
Turn right onto Altamora Avenue.
The consumer is strong. That's really will be validated again in the fourth quarter, when we see that discretionary spending is very high. Amazon will have a fantastic season for the Q4. I already bought probably worth of $500 of stuff just for Thanksgiving, and I'm pretty sure that in the Christmas these things are going to continue. And if I'm doing that, then millions of other people are doing that. And I would expect that Amazon, Lululemon, and the likes of the Macy's and all these guys who are like emblematic of the discretionary spending, those stocks will go up. And the consumers, as that happens, and when the Amazon announces result in Q4, is going to show some surprises, right? So what is really telling us that there are two stories in being built. One is that there is this Fed narrative. The Fed future is showing 5% interest rate in August next year, around 4.8% in March next year, and the Fed currently 2-year, which is the current Fed fund, is around 3.75 ish. The 2-year U.S. bond, which indicates that what's going to be the U.S. bond interest rate, which is emblematic of the Fed future 2 years down the line, that is around 4.4%. So that, in all this together, it's very much baked in the market that our interest rate is going to be higher, which is close to let's say 4.6 to 5%, somewhere on this line. And everybody is talking about that how difficult this is for the market to absorb this. I mean, not only the stock market but also the bond market, the credit market. So if you are an investor, or if you're a small business, you want to get a loan, the short-term loan, to pay your employees. And if you are not making enough money from your business, if you're not like in the short term, so you have a lot of money getting stuck because you're not getting paid right away. Maybe your customers are saying, I'm going to pay next month or the month after. So you want to get the loan even if you have good cash flow. So what happens that if you have a loan, and you're paying like short-term loan, you're paying 4% interest, you got to have the customers are not paying right away. And let's say that in that case, you need to incur some interest, let's say customers are paying 6 months down the line. So you're paying 2% interest for the 6 months for the whole year. And you better have a cash flow which is above the 4% to sustain this business, which is not easy. If you have a lot of capital, you're into real estate business, you will be very lucky to get 4%, 3.4%, 5%. So you can get a good business, can make around 6%, 7%, even 10%. But remember that previously that 6%, 7%, 10%, which was the cash flow, given everything constant, now the cash flow is 2% less. So what that means, they're not going to hire more. They're not going to spend a lot of money from the other places. Now, if the consumer goes, in the same mode because of these layoffs and everything else, they are also going to suffer from the revenue perspective, in addition to the loan, getting the loan to pay their employees. So then what happens next 6 months down the line, when they're going to make around 5-6%, so that they can pay the 2% loan, so with a 3% margin, now the 3% margin is also gone. So they are on a negative cash flow because of this high interest rate that they have to borrow money from the bank. So what happens? I'm just giving these numbers, 4%, 5%. That's really small, very like based on the 4% interest rate that the Fed has today. But actually, the loan will be much higher rate, like 7%, 8% in the bank, because bank has to make some money out of this loan, right? So that becomes even more tougher for these businesses, because the actual cash flow that are the profit margin, the gross margin should be and 15% for the gross margin will be 10%. The operating income, right? So that is sort of those profit, that level of profit is really possible in a good economy. But when the economy kind of takes a swing, then probably it is going to be difficult for everybody. So what that means for the stock market, so that is what we are pricing in right now. The question is that how strong the consumers are right now, right? So that they keep spending the money. They have a good wage. There's a still above the inflation, the current wage, average median wage for the consumer. Then all this kind of data. Now the inflation comes down, which will come down because one way you can credit the Fed, one way you can say that there are things happening out of the COVID, which is why your interest rate is going down. Which is why your supply chain issue is actually getting better. So your situation for the inflation is going down. So this all this kind of complexity comes into picture. So nobody knows really what's going to happen if the inflation goes down, let's say by 3-4%, because the gas price is now, it's right now around crude oil is 79. Let's say it goes to 70, then obviously the big component is inflation will go down, and then you have a rent price kind of constant, right? Or maybe it'll be a little less. The house price definitely went down, so whatever you were paying for the mortgage, about a year ago, it might be lower if you are still buying a new home because the house price has gone down. But generally, because the interest rate is so high, so it's probably going to be just constant. So now a constant means is kind of like a similar, there's a flat line versus last year, the rent you're paying. So the rent component of the inflation is 30%. That may not be that good, but the food price has gone down, the oil price has gone down. Maybe with this inflation or with this recession fear, the restaurant eating, the service, all those will come down a little bit as well. So all in all, the inflation is not going to go back to like 2%, but the rent part will stay, the wage part will stay. So the wage inflation is part of that, but it's probably going to be peaking. So it's not going to go down quite a bit, but it's going to be probably peaking. So we are going to be looking at around 5% inflation. Now 5% inflation means the Fed fund rate should be at least 5%, right? Could be 6%. So if we're looking at 4.5% inflation and 5%, 5.5%, so we still have around 1% more to go. Now the market is anticipating another 75 basis point to go, right? Which is like 50 basis point now, 25 in January, February, 50 in December, and 25 in February. If that happens, then currently whatever the stock price is, that's the S&P that is fair price. Now based on the earning, each of these different companies, whatever the earning comes out, that again depends on how the consumers are paying, how the consumers are resilient. That will determine what the goods buying are going to be in this quarter as well as the next quarter. This quarter probably will be okay. Next quarter, drastic cut down probably because the Christmas is over. It's all now back to the 2023. So Q1 of the 2023 will be terrible in my mind. Even if the consumer have money, they will be very cautious. They will be anticipating job cuts and etc. So they will basically be really, cutting down the spending. So will be the enterprise. So what happens then? The suppliers of those enterprises, for example, the cloud providers, the likes of the Snowflake and the Palo Alto Network and the crowdsource and all these stuffs, they are going to be just also get affected. The Macy's and others, the Christmas is behind them, so they're getting affected. So the stock will fall drastically in January or February, right? Because now these are all behind us, right? Now the question is that then when the Fed is the Fed going to be staying at 5%? If they're staying at the 5% and the stock goes down after this anticipation that the 2020 recession will happen, suddenly you have a 3600. Like S&P at 3600, and so then we are, let's say 36. That's the baseline. When we go back around January, and test that level. Then in January end, we have the Apple earning comes in. They're going to provide the guidance for 2023. The analyst is going to cut their estimate for the next year. That will depend on the actual money the consumer has, the actual, the spending that's going to happen. So it's going to be going down, but how much, nobody knows until those things happen. So Q1 and Q2 next year is going to be a tussle, and based on that, the stock can go back down to definitely just 3600. The next thing will be 3450. That's what the Fibonacci retracement is, and then 50% retracement is, and back. And after that, we're going to go back to 3200, which is basically Fibonacci retracement all the way from the COVID low to the 5200 high, right? So then we are looking at the Q2 results, and then there'll be some stock buyback again, coming back. So that means that we're going to see some really good valuation on the stocks. Now obviously the technology stocks, because that story is not going to be baked completely in until we have a clear it's in the rear view mirror that the Fed is done raising interest rate, when you see that, okay, Fed will be cutting interest rate back again, back to, let's say we have recession and it's going back, and inflation is down and everything else, then maybe next year to second half, we're going to see the likes of the the software companies, the CRMs and the Adobes and the Apple and the Google, etc., will pick up. But until then, what do you buy? I mean, give me one sector that is really going to give you money, defying the market trend. I don't see a single one. I mean, that means that right now there is no reason to doubt that we are going to go test the 4100. I think it's going to happen. I think next week is going to be a little volatile. We might be try to test 3850. Once we fail 3850, we're going to go shoot up again to 44,000. Low volatility, low low volume after that, and then around the first week of December we're going to go test again 42. Then everybody was going to talk about the next CPI report starting the second week of December, and then we are probably going to get a very good CPI report, even if the oil is high and the CPI report shows that flat or slightly up because of the oil. Because remember that the oil price went up quite a bit, like WTI went up to around 90.92 back in October, and back in September, endish and October, and that will reflect in the next CPI. But people will know that that is a fake, and January will be better because they'll start looking at the January, and they know the crude oil actually went down to 79. So this particular aspect, if that is the cause of the CPI to stay high, then people will look past that, they discount that, and then they'll be looking at what the Fed says. The Fed might say that, okay, we are, our CPI has gone down, so we are going to reduce raising the interest to 50 basis point, and we'll see in the February what happens. As soon as that actually comes in, then the market will shoot up again, and market will try to go back. I mean, between now and December, we're going to test 4100. But if we have a good CPI report, we're going to test 4300 between the end of the year. And as soon as we have January, the selling will start, and we're going to roll back to 3600 by the time the the earnings starts for the for most of these companies around January 20th. That's the playbook right now. What stocks we want to buy? I don't think there is a single stock that I can think of that is really good. Generally that we should buy for long term at this point, but good trading options. So I am doing SPY, mostly SPY trading. I mean, like playing a very small amount, like 50, 60 SPI. I'm buying not the options, just the SPI, waiting for like it goes down, because it's range bound between last couple of days between 39.40 and 4,000. So you can average out and then kind of stay short or buy short and buy, keep doing that until you actually break that level of 3900, and then the next stop is 3850. So that's one option. You can also play options long game, right? Like you can actually go for, let's say, December expiry, or even like next week expiry, and be sure that we're not going to be by November 25th going towards the 200 moving average. So you can get a small premium if you're selling call around 4150 and selling put for 3750. So that is one option. Other, I'm playing Amazon a little bit because Amazon is good for, it says kind of looks like a buying opportunity. This point is going to test $100 very soon. So right now it's around 94. So I bought some calls today for Amazon. The third one is bought some calls and sponsored that with a 90 put, and a sell call at 100. The third one, I think there will be like good options coming up with next week's earning. The little earnings will continue, and watch out for Lulu and others. So that's the theory right now. Keep doing the trading. Do not buy into the stock for the long term.